Good afternoon and welcome to another RISE ETF webinar. My name is Gaël Tiampon and I'm the head of marketing at RISE ETF. We are Europe's first specially thematic ETF issuer, with our founders having pioneered thematic ETF investing in Europe back in 2014 with the launch of the continent's first robotic ETF. At RISE, we believe there is a better way to invest in the future, and therefore, our ETFs provide investors with unprecedented access to the megatrends that are transforming our world in a way that's accessible, transparent, and purpose-built. We're creating a new approach to investing, one that enables investors of all stripes to invest in the future while remaining on the right side of history. I'm joined here today by Anthony Martin, co-founder and portfolio management lead at RISE ETF. Anthony has a wealth of experience in ETF implementation, portfolio management, and capital markets. He was the head of ETF portfolio management at Legal & General Investment Management, and prior to that, at ETF Securities, where he was responsible for managing the offering across fixed income, commodities, and equity ETFs. Anthony has over 10 years of experience in the ETF industry, building and managing ETFs from the portfolio management and operation through to the capital markets. This has enabled him to gain extensive detailed knowledge and insights into the key areas of the ETF ecosystem. Before we begin today's presentation, I need to address some simple housekeeping. 1, please note that we have left time in the end to address any questions. If you would like to ask a question during the webinar, please type it into the Q&A panel and we will seek to address it at the end of the webinar. Remember that you can also submit your questions anonymously. 2nd, please note that there is a button in the control panel to raise your hand for any technical issues. If you're having any display or sound issues, please raise your hand and I will get in touch to resolve the issue. We're going to be distributing the presentation slides after the webinar is finished. The recording will also be made available on our website shortly. Finally, this webinar is registered with the financial planners in Germany and Austria, and therefore eligible for continuing professional development credits. Please feel free to get in touch with us after the webinar in order to receive your confirmation of participation. Without further ado, I'm now leaving the floor to my colleague, Anthony.
Thank you, Gaël, and thank you everyone for joining. So today we're focusing on ETF liquidity. We're going to start by looking at some basic concepts, move on to key aspects in determining ETF liquidity, considering the ETF structure, ETF arbitrage, premiums and discounts. We'll include a recent example of high yield ETFs during the coronavirus, all of which are relevant to ETF liquidity. So we're going to start with what is an ETF. We'll move on from this quite quickly. But there's many different types as ETCs, ETNs, ETFs. We're focusing on ETFs specifically. So they're just like traditional mutual funds, but instead can be traded on demand throughout the trading day on exchange. Mutual funds traded at the end of the day only. So ETFs are issued in Europe. They're generally regulated under the UCITS framework. So this includes strict rules on diversification, including diversification and liquidity. You can tell if it's a UCITS ETF because they're all required to have UCITS ETF in the name. So in case you get confused between the different types of structures, if it's a UCITS ETF, it's not an ETC or an ETN. So what is liquidity? So I think starting with basic liquidity of stocks and shares, liquidity is a crucial aspect for any investors, as essentially it determines your ability to liquidate your position, which is the main concern. So different levels of liquidity determine whether you can sell on demand, sell over a number of days, or if something's completely illiquid, not sell at all. So public traded companies, it's very simple. You look at the price of the stock times by the number of shares traded over a given period of time. So that'll tell you what the average daily volume is of that stock. So you compare your trade size to liquidity available. So here we've got £100,000 if you want to trade that in BP. The average daily trading volume is £150 million. Clearly there's no issue getting into or out of your position. And you don't have to worry about impacting the price. If you invest £100,000 into a much smaller company that normally trades only £50,000 a day, clearly you're going to have issues. As a guide, you don't normally want to go above 25% of the average daily volume. So here, you're likely to sell over a number of days unless you want to negatively impact the price. Now, what's important here is this is how you measure liquidity for public traded companies, but this doesn't hold true in any way for measuring an ETF's liquidity, which we'll get onto. So how do you measure ETF liquidity? I think the key takeaway here is that a lack of exchange traded volume does not mean that an ETF is illiquid. True liquidity means you need to look through to the underlying assets. So as an example, we've got here two ETFs. One trades $5 million a day, one trades zero. The $5 million a day ETF tracks junk bonds, and the one with no volume tracks US Treasuries. Now, traditional look at ETF liquidity would say, which one is more liquid? Clearly, the one with junk bonds. But this isn't a publicly traded stock. It's a fund. So you need to look at the underlying liquidity. The underlying is what the ETF actually holds. In this case, you're much better off with the ETF that's got zero traded volume, which we'll get onto shortly. And that's because US Treasuries are significantly more liquid. Again, always look at the underlying. So why are the underlying assets key to ETF liquidity? I think it's important to know what happens when an investor buys an ETF. So we'll get into more detail on the structure shortly, but ultimately, when there's inflow, the fund manager needs to buy the underlying assets. And the assets are determined by the ETF's investment objective. So it's the open-ended nature that's key to their liquidity. So really, we need to look at why in the previous example, a US Treasury is more liquid. So here it's because you're looking through to the underlying assets. So the investment manager, when you're buying the ETF, is buying those US Treasuries. It's not relevant what the actual exchange volume of the ETF is. So here, if we look at the FTSE 100 example, an investor buys 20 million, which means you need 20 million pounds of new ETF shares of that ETF created. So when you create the new shares, 20 million pounds has gone into the fund, new ETF shares have been created. The investment manager needs to buy 20 million pounds of the FTSE 100 companies. Now, clearly that's not going to be an issue given the liquidity of the FTSE 100 companies. Now, the volume of that ETF itself traded on exchange is of zero relevance to the investment manager's ability to buy those underlying companies. So we're going to move on to the ETF structure. So the only way to understand ETF liquidity is by understanding the structure. So we're going to explain primary and secondary market for ETFs. The primary market, ETFs are open-ended. It's a key aspect. Therefore, new shares can be created and also shares can be redeemed. So this all happens via the primary market. That's where the number of ETF shares in issue goes up or down. In the secondary market, this is all other ETF trading. That is not directed directly with the fund issuer. So importantly, that covers all aspects of exchange trading. And to understand exchange trading, you need to understand the role of the market maker. So we'll start with the primary market. So this is where ETF shares created and redeemed directly with the ETF issuer. This is available only for authorized participants, called APs. And these are typically institutions that cover market makers, but also ETF trading desks. So ETF trading desks at different investment banks, for example, are likely to become APs. And really anyone institutionally trading, broking ETFs has a motivation to become an AP so they can trade directly with the fund to satisfy client orders. So you can have, when you first start, you can have one AP, or if there's a lot of demand and there's a lot of people buying and selling your ETFs, you can have up to say 30 APs. But ultimately the core requirement is that you have one. So that's your link to the ETF issuer. So when APs trade with the ETF issuer, this is when the investment manager buys and sells the underlying, which is the key part of this whole webinar. So this is why the underlying liquidity is relevant. So why are APs important? They're the link between the ETF and the secondary market, making the whole structure open-ended. So the ability to access the primary market closes that loop essentially with the secondary market. And this ensures that ETFs trade at fair value, which we're going to discuss a bit later with ETF arbitrage. Now, without the primary market, the ETF exchange volume would be relevant. So if there was no way for market makers to create and redeem the ETFs, then you would look at an ETF's liquidity just like you look at a normal company's, and you would look at how much it trades. And that's why having the APs means that's no longer relevant, because they don't need to offload their positions on exchange. They can do it in the primary market. So if you didn't have a primary market, that would also mean you've got significant premiums and discounts, because it's all about the demand for your specific ETF will determine the price. So if we now look at the secondary market, so this covers all exchange trading, but also includes OTC trading as well, so over the counter. This is normally OTC trades are between larger investors and brokers who have decided to go directly to a broker rather than going via the exchange. On exchange, it's primarily market makers who provide the liquidity for investors who are buying and selling. So market makers price the ETF according to the real-time value of the underlying assets. So what happens is, for any ETF issuer, certainly in Europe, you'll have one contractual market maker who is specifically for that ETF commits to providing liquidity. So they register with the exchange, and there's three key aspects to what they're committing to. So the first is there's a minimum amount. So they have to provide a bid and an offer, but they need to do it in a reasonable size so that investors can buy and sell that ETF. So for ours, as an example, we have 100,000 euros. So our market maker, SocGen, is committed for our ETFs to ensure that at any point you should be able to buy or sell 100,000 euros of the ETF on exchange. Now, they also have to commit to a price, and this is the bid offer spread. So this is you agree with them a maximum percentage for them to price your product. So you could say, for example, the maximum spread we're going to agree with you based on the underlying assets is going to be 0.3%. So you'll never have the buy and the sell price will never be further than 0.3% apart. And the other key aspect is the minimum participation. So what this means is it's no good them coming in from 8 till 10 in the morning. They've got to be there throughout the whole trading day. And this is what's monitored by capital markets divisions within ETF issuers to ensure that the market maker is always there. So they'll be trading thousands of ETFs. It's possible they could be out of the market for a second for whatever glitch, and that's where the ETF issuer just ensures that they're always there for coverage. So the key aspect of market makers is they're always making sure that ETFs trade at fair value, and that's according to the liquidity of the underlying assets, which is again why you don't need to worry about the ETF volume on exchange. So how do they ensure the liquidity? So firstly, they won't contract to be a market maker for your ETF unless the underlying assets are sufficiently liquid. So they're taking on a responsibility. So that means that they've got their own risks. Therefore, they're incentivized to ensure that whatever product they're pricing for is actually a tradable product, or they're going to lose money at the end of the day. So they also have access to the primary market. So that means they can settle their positions. So if someone's bought $500,000 on exchange of an ETF, that market maker's sold it, they've got a short position. So they can cover that by buying in the primary market. They don't need to go and find liquidity on exchange. So that's, again, the open-ended nature of it. Now, the amount they can access is dependent on the underlying assets liquidity. So if they had 50 million short position and they need to buy those ETF shares, they go to the primary market. Then what's important is that the issuer can then satisfy that trade. And the way they satisfy that is dependent on can they trade 50 million of the underlying securities. So how do market makers price the ETF? We're going to start with, or they start with the NAV. So the NAV is the official valuation by the administrator. So you'll get that from the previous day. They also receive a full fund breakdown, and they apply market moves to that. So you might have a NAV of 100, and then it's gone up. That was yesterday. The markets have moved 5% higher today. So the market maker will know that it's gone 5% because they've got all of the underlying assets. They've got visibility on the portfolio. And they know the live price is now 105 per share. So based on 105 per share, they go and give their bid offer in the market and the 100,000 euros worth of shares available on each side. So what's also important here is that once that 100,000 disappears, they then replenish it. That's not done for the day. So they'll continuously be repricing. They're not going to go out and put 10 million available on each side. You know, if they have a pricing issue for whatever reason, that leaves them heavily exposed, but they will keep replenishing it. So if you wanted to trade more than what's available at the bid and offer, that's still very possible. It just has to go in various chunks. So here's just a summary of what we discussed. So I think probably the key aspect of this is if you just remove the ETF issuer part of it, then you've got exactly what a normal stock or shares trading like. No open-ended aspect. But because market makers and authorized participants can trade directly with the ETF issuer, it's a whole completely different structure. And that open-ended liquidity is there, which is why it's the underlying liquidity that matters, not the demand to buy and sell the ETF. So why can ETF exchange volume be misleading? So without trying to be too repetitive, it's relevant to the liquidity of the underlying assets. So it's not a zero-sum game. So the market maker doesn't need to go and find an investor to buy their short position if they've sold it on an exchange. They've got that from the ETF issuer. So you can have one-way flow. An ETF can trade on exchange and only have buys the whole time. There's no need to have, find a fair value with the buys and sells. Everything goes through to the primary market where there's any excess or deficit. So the market maker hedges their position, and they do that by trading the underlying assets. So if they've sold the ETF on exchange, then they're short. They need to buy the underlying assets, and then that makes them market neutral because they don't want to have a direction in the market. They're making a cut of small margin. And then when they create at the end of the day in the primary market, that's when they close out their hedge and they're back to no positions. So really, again, we're just repeating that the relevance of the ETF shares at trade is just how popular the ETF is. It's nothing to do with the liquidity. So just to continue on, we'll give an example. So here we've got a FTSE 100 ETF, launched a year ago. Say there's no demand from investors whatsoever. So it's too expensive, management fee wise. They came late to the market. No one's traded the ETF, 0 shares traded on exchange. But there's a market maker, as there is for all of them in Europe, who's committed to price that product and has access to the primary market. Now, if this is a publicly traded company, then it's completely illiquid. You wouldn't want to touch it with any reasonable size of investment or probably any investment at all. So can you go and put £50 million into this ETF? And the simple answer is yes. And the reason is that market maker has no need for liquidity on exchange. They need to know they can create 50 million in the primary market. So because the investment manager looking to buy 50 million of the FTSE 100 companies is very easily able to do that, then there's no issue. So here, this is an example of why you can trade 50 million in something that has no volume without any issues, given the underlying assets can handle 50 million being traded. And the other important aspect here is you might think, right, that might boost the price of the ETF. And the truth is for this one, that won't make any impact on the price. And we'll go into that a little bit later. So how does ETF arbitrage work? So ETF arbitrage explains why you have the fair value on exchange. So ETF exchange volumes and ETF demand shouldn't impact the price. So if here we've got an example of an S&P 500 ETF. So say the NAV's 100, today's fair value is 101. So the S&P 500 stocks have gone up 1%. Fair value should be 101. That's where it should price on exchange. But a market maker, for whatever reason, has stale prices. And so they have the price set at 100 and they put their bid offer around 100. What happens is more or less instantly, and market makers are permanently looking at discrepancies in prices to see where they can make a profit. So you'll have other market makers instantly coming in, buying as much as they could possibly afford, as long as they know that the underlying is sufficiently liquid. So they can buy, for example, 50 million at a 1% discount. Then they're long the ETF. So then they would short the underlying S&P 500, maybe via a future. They're market neutral. And then in the primary market at the end of the day, they redeem their 50 million position in the S&P, get rid of their underlying hedge on the futures, and they've made 500,000 risk-free. So this can all happen very quickly. And to give you an example, back in I think it was 2010 or 11, we had some short and leverage ETFs on some mainstream indices. And one of the market makers, not the contractual one, but you often have multiple market makers pricing your funds, they misinterpreted a dividend and essentially ended up doing this example. So it was, they traded 1%, they were offering a price 1% lower than the fair value. So what happened is, this is 8 a.m. in the morning, by 8:10, a ETF that normally trades up to 1 million a day on exchange traded 100 million. And this is because of that arbitrage mechanism. All those people who bought that ETF were able to redeem in the primary market and make a risk-free profit. Now, in practice, that was a long time ago. Most market makers now are a lot more advanced. So any issues in pricing, they've got very advanced systems and technology that flag any unusual trading, so to prevent them losing money in that same way. So it's unlikely that type of thing will happen again. But I think the key point is there's a lot of assurance that your ETF should trade at fair value, because otherwise it can be arbitraged by other market makers. So does size matter? This is a question that we get quite a lot. And really this comes down to a big misconception that if you've got low AUM in your ETF, then it's a lot more risky and a lot less liquid. So we'll use an example of FTSE 100 ETF. So you've got assets of only 1 million, so that's your AUM. An investor wants to buy 50 million, so 50 times what the existing fund size is. So this is where a lot of people would think that's actually a risk. But from a liquidity standpoint, given this is a FTSE 100 ETF, there's no risk there whatsoever. So when the investor buys 50 million, again, the market maker will create, and the investment manager will then go and buy 50 million of the underlying assets. Now, the investment manager would also buy 50 million of the underlying assets if that fund was worth $1 billion. So whether it's 1 million or 10 billion, it doesn't matter. The buying of the 50 million is buying 50 million FTSE 100 companies. So the process is the same, the liquidity is the same. So now the ETF has 51 million and they want to sell it. So can they sell 98% of the total assets of that fund? And the answer is exactly the same process happens. Can they sell 50 million of the underlying securities? And the answer is yes, they can. So really, the only two things you should consider are, can they still track the ETF? So when it goes down to £1 million, can they track the FTSE 100? And the answer is yes, because it's £1 million is sufficient to have investments in those 100 companies at the same weights of the index. The other issue you should have is it commercial? So really, it's not a case of there's a liquidity concern, but if a fund's going on for 5 years and it's at £1 million, you know, is the issuer likely to shut that fund at some point in the near future? Which won't necessarily lose you money, it just means they sell for you, but that would be the other consideration. Now, if someone's just launched a fund, there's obviously a very low probability of it shutting. It's more if there's no demand for a long period of time. And then there's other, in terms of that ability to track. So an example here is if you've got a corporate bond that's 500,000 assets under management, and it tracks 1,000 bonds, it's obviously not going to be able to do that very effectively with that amount of money. So you need to look at what's the minimum value that that fund can operate and actually effectively track the underlying. So on the flip side, one that gets asked less often is, does the can an ETF be too large? And here we've got two examples. One is 1.5 billion, one's 100 million. And both of them can trade 50 million in a day. And the way we look at that is, how much can you trade of all of the underlying basket of securities in the same percentages they are in the index without going over 25% of the daily volume of that individual stock for any of the stocks in that index. So here we're assuming 50 million is the cap before that happens. And it's exactly the same in both ETFs, both track the same underlying index. Now, which one would you have more of a concern with the size? So in this example, if you wanted to sell 50 million, you're selling, which is the cap, then it means ETF A with 1.5 billion can only handle a 50 million redemption. That's 3.3% of the assets. Whereas the second ETF can handle 50% redemption without impacting the underlying securities. So this is completely to do with the underlying securities. So potentially a misconception, but you'd actually, so ETF A, if it had 5% redemption, so other investors in that ETF wanted to sell at the same time, it's going to potentially start moving the market. So sometimes you need to consider also, is an ETF too large? So it's not just on the smaller sizes that you need to start looking at the details of actually what this ETF can handle, and has it potentially hit a capacity? So we're going to go on to why ETF premiums and discounts can be misleading. Start with what a premium or discount is. So this is when an ETF trades on exchange higher or lower than the fair value, which is generally measured as the NAV, and that's an end of day value. So it normally looks at, is the NAV of the ETF higher than the closing price on exchange of the ETF? And for a lot of ETFs, the metric's completely meaningless. And to understand that, we'll just look on the right-hand side. So how's the NAV valued and how's the ETF closing price valued? So the official NAV uses the local exchange closing prices. So if you have US equities, that'll be the close in the US. If it's Asian equities, the close in Asia. The FX, the standard market standard, is to use a 4 p.m. benchmark. That's 4 p.m. UK. Now the ETF closing price at 4:30 UK, for example, it is going to be the price of those equities at 4:30 UK and the FX back to base currency of those equities at 4:30 UK. So clearly there's a mismatch, and that's why you're not comparing apples with apples in this example. So if we look at a US ETF, just to illustrate that, you have, even if we just take an S&P 500 ETF, the NAV is going to have the closing price as of 9 p.m. UK. The closing price on exchange is going to be whatever the price was at 4:30 p.m. So you've got almost 5 hours difference, which is market moves, which is about as useful as comparing one NAV from today to a NAV yesterday and saying that's a premium or discount. It's not reflective of an actual deviation. So the only way it would be reflective is the ETF you're looking at, all the underlying stocks close at exactly the same time as the ETF stops trading on exchange. And even then, if there's any FX involved, that's at 4 p.m., not 4:30. So you're going to have half an hour of FX moves. So the question would then be, how can you tell what's a genuine premium discount? And the answer is that's really what the market makers are doing every day. That's their bread and butter and their expertise and what all of their systems are doing. So they're pricing real time what that ETF should be based on the live prices of those underlying assets. And as we've seen in the premium and discount section, if they get that wrong, another market maker can come in and make a profit. So commercially, they're very incentivized to make sure they're pricing at fair value. And what they need for that is just full transparency on the underlying assets of that ETF. Now, the caveat to this is that for equities that are live and trading, it's all very, very straightforward, but sometimes pricing can be more subjective. It might be that you've got an ETF on Japan and it's closed 5 hours ago, but you still need to give a price. So you need to factor in, right, to what extent is the US market moves going to influence those prices when they open tomorrow? So there'll be all sorts of factors a market maker will look at where they cannot directly trade the underlying during trading hours. So we're going to look at premiums and discounts during the coronavirus. So this is basically high yield bonds. Generally, we talk about equities. Rise only has equities at the moment, but it's probably useful just to give a bit further background on what can happen in the bond market. So what happened was during the recent market turmoil, there were massive discounts in high yield bonds, ETFs. So the markets dropped heavily. There's one-way selling. That means market makers are redeeming. They end up with a net short position. Net long position. So they have to then redeem the ETF. And the ETFs were trading at some potentially up to sort of 20% discount. And critics were saying that you wouldn't get that in a mutual fund because you get the actual NAV value. So it's not actually that simple. So what you need to know is how the NAV is valued. So we've discussed it just then for equities. But for bonds, there's multiple price sources. So normally these are quite similar, and the NAV is going to verify the price or look at multiple sources or have a hierarchy of which source it has as a primary pricing. But in times of market stress, that price is not really going to be a tradable price. It's not like the closing price of an equity. So here we've got an example of a pricing source could say 80, but that's just an independent valuation saying this is what we think the bond is worth from a pricing source. Could be Reuters or whoever else, or Bloomberg. But that doesn't mean you can trade at that level. So if you actually say, I want to sell that bond, the actual price for selling 1 million could be 70. So the quoted prices aren't necessarily going to be representative. So in this case, the NAV is actually overstated and the ETF is what people are actually willing to execute those bonds at and more representative of what the fair value is. So just to continue on, what's the difference between why would a mutual fund not be beneficial in this example? Just understand how the process works and how it's priced. So when their market maker redeems, the AP trades, they're the AP, they trade the trading costs, including any trade slippage. And trade slippage is where if the investment manager has sold a bond at 50, but it's priced in the NAV at 80, then they will ask for 30, that difference from the market maker. And what that does is it ensures that any remaining investors are not hard done by and are not losing out because you've allowed people to redeem at a falsely inflated price. So you actually charge the AP the actual value of redeeming. Now you can also have a fixed fee. So if someone says, actually, we'll just do fixed 50 basis points, then the market maker might say, okay, well, I can cash in here because the actual cost should be about 5% because the NAV's overstated. And so what happens is the ETF issuer needs to make sure they're just very dynamic in repricing their fixed fees. So if we use Trump for an example, after he got elected, there was a lot of market turmoil. And what happened was a lot of ETFs, we had an emerging market bond ETF at the time. This is back in ETF securities. And people were desperately trying to redeem at the fixed fee, knowing full well that the NAV was overstated. So they were getting effectively an inflated price. So what you do is you either have to adjust your fixed fee or you say it's only applicable up to a certain level where you know you can liquidate that level, that size. So the ETF structure in this whole example led to price discovery on exchange for the actual value of where these bonds are trading. Now going on to a mutual fund. So any mutual fund that's letting you redeem at NAV is going to be penalizing the existing investors where that NAV is overstated. So that's where they should be applying swing pricing to prevent you from redeeming at NAV. So they need to adjust the price to reflect the actual sell price. And so this is quite a key difference. So you shouldn't be able to just go to a mutual fund and redeem at full value, whereas at an ETF, you'd be getting the exchange price, because if you're getting full value on that mutual fund and the NAV is overstated, all those remaining investors are going to be losing out from inflated prices. So that's where it's important to have the right mechanism for pricing in the primary market, which is in place for both. But I think you certainly had a lot of critics saying that you can just go and trade at NAV in the mutual fund, which, you know, you can trade at the APs trade at NAV for the ETF, but they do pay the associated trading costs as they should for a mutual fund. So thank you for listening. I think all these slides are going to be made available to you. And we've got some time now for some questions. And if there's anything that comes up that you want further detail, obviously it's a limited amount of time to go into every aspect of liquidity. But feel free to email us and we'll do our best to get back to you quickly. So I'll pass back to Gail now for any questions.
Thank you, Anthony, for the great presentation. So we have a bit of time now for questions. Just as a reminder, if you would like to ask a question, please type it into the chat box at the bottom of the control panel and then click submit. We will also be sending a few polls to gather feedback from you. These will appear on your screen and are fully anonymous. So we'd really appreciate if you could engage with them. So I'm looking now through the list of questions and I can see first one that is popping up is, how can an investor measure the liquidity of ETFs?
So it's a good question. It's quite a tricky certainly for a retail investor. It would be very difficult to run a liquidity analysis without all of the data. But essentially what you need to do is you need to look at those what percentage weight is each underlying security, and how liquid is that, and how does that impact the overall ETF? So for example, if one stock trades 100 million a day, that on its own is not sufficient information. Is it worth 1% of the index, or is it worth 20% of the index? That's really, so the weighting is a key aspect of how liquid the ETF is. So in practice, you can go to Bloomberg, you can get all of the data, or any data provider similar. But really the ETF issuer certainly would be able to help with that. So we often get ETF liquidity questions, and what we do is we send back an analysis to go through, how much do we think you can trade of this ETF a day for 100% of the portfolio, for 95% of the portfolio. You can also go on Bloomberg and use, it's called ETFL. So once you're on the ETF page, you go onto ETFL, and it will show you how much you can trade of that fund without going over 25% of the average daily volume in any individual security. Now, I just caveat that one that is a hard restriction. So if there's one stock that's worth 0.1% of your index, of your fund, that's restricting it, then it'll essentially say that's going to be the limiting factor, whereas you could probably trade 99.9% at a much higher, handle a much higher trading volume. So always take it with a pinch of salt, but the ETF issuer should be able to help you with any questions around that.
Thank you, Anthony. A second question that is popping up is, if an ETF tracks an index, are you purely dependent on the index liquidity?
So if it tracks an index, so in a way, yes, you are. So the investment manager has always got a requirement to look at the index, but also look at the fund separately. So they've got a responsibility to the fund. That's part of their regulation. But in practice, if you want to track the index, which is the job of the ETF, then yes, you need to look at the index liquidity. Now, before you start an ETF, you need to look at whether you're constructing it yourself or using a third party. You'll have restrictions in place around liquidity. You also have a consultation, and we've seen this with previous funds we've managed, where you can adjust the liquidity in the index as the fund grows, because the index needs to cater for the money that's following it. So an example in our ETF, so if you take our cybersecurity ETF, for example, there's a 35 million cap where you should always be able to trade 35 million without going over 25%, which is done at each rebalance.
I'm scrolling through the different questions that we have. Another one is, what other considerations are there outside of the maximum trade an ETF can take in a single day?
I think here you've got to look at, so we used the example earlier of a fund that's 1.5 billion, and if there's a kind of handle a 50 million trade. So the other big area is really rebalances. So if you're looking to, it's not just whether you're trading in and out of the fund, it's how effectively could they track the index and how effectively can they rebalance. So if you have a high percentage turnover of a large fund at a rebalance, then the underlying liquidity needs to be able to handle that. So that's another important aspect. And there, what you need to know is how much turnover is expected to happen at the different rebalances. And different weighting methodologies will have very different turnovers.
Thank you, Anthony. As you can see, there's a few polls going on your screen at the moment. Thank you for answering them. And I just, as a reminder, they are all completely anonymous. Another question that has come up is about authorized participants seem to be a key part of the ETF structure. What obliges them to create and redeem?
So yeah, it's a good question. I think it's one that the regulators are looking at as well. So we had a few conversations with the Central Bank of Ireland. So most ETFs are regulated by Central Bank of Ireland, or they're regulated in Luxembourg in Europe. And they're looking into it, and because essentially they're outside of the sort of sphere of influence of the ETF issuer. So whilst everyone else in the your administrator and everyone else in your market maker is contractual, you can't make someone buy and sell your fund in the primary market. So what that means is essentially they don't have that obligation. So the first question is that a major risk? And I think the answer is they're commercially motivated. So for these people, It's their bread and butter of making money is creating and redeeming ETFs. That's what they specialize in. They take, it could be around 1 basis point, so 0.01%. So for them to make money, they need to do that. What you need to do is ensure that you make your ETF as tradable as possible, so liquid underlying assets. And these are all discussed with APs in advance. But ultimately, the reason an AP wants to buy or sell is because there's investor demand. Otherwise, they wouldn't be doing that activity. So if someone goes to them with a 10 million trade to buy, they're going to make money off that. And so they're motivated to put the trade through. Otherwise, they'd have to say no to it. You've also got, and I wouldn't really stress this point too much, but you've also got in the prospectus, you're obliged for UCITS ETFs to have wording along the line saying that investors, if they can't trade out of their position on exchange, they can come direct to the ETF issuer. Now, as far as I'm aware, that's never really happened. But there are sort of safeguards in place, and I think it's highly unlikely that you're going to come under a situation where all APs disappear and all of a sudden there's a huge disconnect between the primary and secondary market.
Another question that has come up is, are you effectively limited by the most illiquid holding within the index, or do you move to an optimized approach to avoid being constrained by one constituent?
So if you have an optimized ETF, so you track it, you're not tracking exactly one-to-one to the index with every underlying constituent, yes, then you certainly can restrict out certain, you can have a liquidity threshold. So, but what you also need to bear in mind is that normally an ETF will decide when they launch, are they going to be optimized or are they fully replicating? And when you decide that, you base it on what you're tracking. So if you're tracking a 30 stock fund, a 30 stock index, you're going to be fully replicating most likely. If you're tracking 1,000 corporate bonds in an index, then it's going to be optimized. So yes, there is an element of, I wouldn't necessarily say discretion, because it depends if you're fully replicating or not. But yes, so you can technically avoid tracking certain aspects of the index. But at the same time, when you're looking at an index to track as an ETF, certainly on the issuer side, you want to make sure that's a feasible, tradable index. So it's no good picking an index that has got 10 or 20% that's not tradable. So yes, it's possible, but ideally you'd start in the first place with an index that you feel is fully replicatable.
And another question that has come up is, does security lending impact on liquidity during a market shock?
So I think what's really important here is every fund that takes part in securities lending is going to have their own securities lending risk appetite. So what that means is you can decide to lend out 90% of your portfolio, 10% of your portfolio. All these risk management aspects are decided by the issuer ultimately. So what you want to do is firstly look at what risk management they have in place and how much of the portfolio they lend out. And it's also not necessarily good to just say what was the average lent out last year, because it could be the case that it's zero for most of the year, but there were a few days at 99%, and therefore, that's when you've got the big risk, not what the average was. So I think first thing to say is look at that aspect of it. I think the other aspect is, right, so you want to sell the ETF. Let's say you want to sell the whole thing. You've got 100 million under management. You've got 100 million redemption. You've lent out 50% of that. What that means is you need to recall those stocks. So that means if you've lent them all out, you need to recall them, and the person you're recalling them off has gone short, presumably. So they've sold the ETF. They've sold those stocks. They would then need to buy it back and return it to the fund. Now, there's all sorts of indemnities and things you can have on people defaulting, which is a separate issue where you have collateral and you can choose government bond collateral, equity collateral. Again, it's all about the risk management of the ETF issuer. But as long as they can buy back those stocks, and the presumption is in a market stress that buying back the stocks isn't the issue, selling the stocks is the issue, that they should be able to return those. So I think in theory, these people could default, where you then rely on collateral, but in practice, I'm not sure there's been many examples of that happening. So we have no stock lending on our funds at the moment. But yeah, I think what you've got to remember is you're not asking people to when they return collateral back to the fund, return of stocks back to the fund, you're not necessarily asking them to sell, but you're asking them to buy them back and then return them. So it's easier to buy back in a market stress than it is to sell.
Thank you, Anthony, for this question. There is a lot more questions that are coming up, but we're just trying to be mindful of the time here. We're getting close to the 45-minute mark. Therefore, if we haven't answered your question, please feel free to reach out to us or Anthony. There's his email address on the slide, and you can also reach out to us at info@riseetf.com. As I mentioned at the beginning of the webinar, we'll be sharing a copy of the presentation as well as the recording will be made shortly available on the website. Do not hesitate to reach out to us for any more questions. Thank you again for attending, and we hope you have a great afternoon.